So how did giant companies get thousands of people, all doing different jobs, to move in the same direction? Well, it's not by magic, that's for sure. It's all about having a system. Today, we're going to crack open performance management, a topic that's not just crucial for your SCMP paper, but honestly, it's an essential skill for anyone who wants to succeed in business. Let's get right into it.
What you're looking at here, well, that's our roadmap for today. We're going to start at the top with the big picture performance management system. Then we'll dig into the philosophy behind it, which is responsibility accounting. And finally, we'll see how performance reporting turns all of that into action. You'll see it's a perfect interconnected loop.
And here's exactly how we'll break it all down. We're going to start with the big picture, then jump into the nuts and bolts of the four-stage system. After that, we'll get into the philosophy that really makes it tick, the reports that make it actionable, and of course, we'll wrap up with a quick-fire recap to make sure all of this is locked in for your exam.
So, what's the real challenge we're trying to solve here? I mean, why do companies even bother with these complex systems? It really all comes down to one simple but absolutely massive question. Now really think about it. You've got the CEO, you've got the junior team member, and everyone in between, all making dozens of decisions every single day. Performance management is the framework that's built to make sure all those little decisions, all that individual effort is all lined up and pushing towards the exact same strategic goals.
So the solution to this huge alignment problem isn't just to cross your fingers and hope for the best. It's a structured system. And for-profit companies usually follow a pretty clear four-stage process to get it done. Let's walk through it together.
Okay, so step one, you've got to have the right structure in place. Then, step two, you delegate authority, and you create these things called responsibility centers. And that's a really critical idea we'll get into in a moment. Step three is so important, you have to decide what you're going to measure using both financial and non-financial metrics. And finally, step four, you review the results and you take action. See the flow? It goes from structure to delegation to measurement and then to action.
Now listen up, because these are your exam keywords. For a performance management system to really work, it needs to be robust. That means it can handle the messiness of a real business, not just some perfect textbook scenario. It also has to be open to new information, like a competitor making a surprise move, and it has to be able to adapt. And it must be cyclic. It's a continuous loop of reviewing and improving, not some report you look at once a year and forget about.
All right, so we have our system. But for that system to be fair and for it to actually work, it needs a guiding philosophy. And that's where responsibility accounting comes in. Think of it as the information subsystem that powers the whole thing.
So, here's the key takeaway. You are only judged on what you can actually influence. It's such a simple idea, right? But it's so powerful. It's what makes sure that performance measurement is fair, it's motivating, and it's directly tied to the decisions a manager can actually make.
Okay, let's put on our case study lens to make this totally real. Meet Maria. She manages a coffee shop. Now in SCMP terms, her shop is what we'd call a profit center. Why? Well, because she's responsible for both the revenues, from selling all that coffee, and for costs like the coffee beans and her staff's hours. She doesn't get judged on the rent for the corporate head office because she has zero control over that. She's judged only on the profit her specific shop generates.
And Maria's example just perfectly lays out the core principles. This system works for all kinds of centers. You might have a factory manager who runs a cost center where their whole focus is just on controlling production expenses. Or you might have a big divisional head running an investment center where they're responsible for profits in relation to the capital invested in their division. But the logic, the core idea is always the same. Authority is delegated and managers are only judged on what's actually in their control.
So we've got the system and we've got the philosophy, but how do we actually see it? How do we turn all that data into actual decisions? Well, that's the job of the performance report. This is the tool that brings it all to life. To put it really simply, a performance report just takes what you planned to do and puts it right next to what actually happened. And the whole point is to find and understand the difference between the two, which we call the variance. It's that variance that acts like a big flashing sign, telling managers where they need to focus. Let's see how this plays out. So on one side, you have your actual results, the raw numbers of what went down. On the other side, you have your budget, or your standard. That's the benchmark you're aiming for. The gap between them? That's your variance. And a negative, or what we call an unfavorable variance, is a super clear signal that something needs a closer look.
And here is another one of those critical comments from the material that you just cannot miss in an exam. If your original budget was totally out of whack, I mean way too easy or just impossibly hard, then any variance you calculate is basically meaningless. The quality of your baseline, your budget, dictates the quality of your entire report. It's that simple.
Now, this is a pretty cool insight into how the information flows. It doesn't start at the top and trickle down. It starts at the bottom and moves up. So the most detailed reports are at the lowest levels of management. As those reports go up the chain of command, they get more and more summarized. So our friend Maria gets a super detailed report on our coffee shop, but her regional director just gets a summary of all the shops in her area. This makes sure everybody gets the right level of detail they need to make good decisions.
All right, we have covered the system, the philosophy behind it, and the tools they use. Now let's lock in those key definitions with a quick keyword flash. First up, the performance management system. Remember, it's that 4-stage process of structure, delegation, measurement, and review, all designed to guide a company towards sustainability. Next, responsibility accounting. This is that core philosophy. You are only, and I mean only, judged on what you can directly control.
And finally, the performance report. That's the practical tool that compares actuals to the budget to highlight variances and, most importantly, trigger action.
So we're going to leave you with this final thought to chew on. This whole system we talked about is built on the idea of individual control. But what about the big stuff? Systemic issues like a market downturn, new government regulations, or some crazy new technology that disrupts the whole industry. If Maria isn't responsible for those things, then who is? It's a question that takes us right to the very heart of what strategic management is all about.